Press the bell icon on the YouTube app and never miss another update.
AS 22, Accounting for Taxes on Income. Perhaps we will not need this accounting standard if what we are doing in our accounting books and what is allowed for tax is the same. But we know it is not so. What we do in our accounting books is based on accounting standards, and what is allowed for income tax is based on the taxation law. And there are so many places where the taxation law differs from what is permitted by accounting standard. This causes a difference between your profit as per the accounting records and what is the taxable income as per the tax provisions. How should these differences be treated? That is one of the objectives of this accounting standard. So what are the different items where there is a difference between what we do in accounts and what is allowed for tax? One of the classical example is depreciation. We know we will be following the accounting standard 10 and provide for depreciation in our accounting records. Well, as far as income tax is considered, we have an absolute different concept of block of assets, and that is how we compute depreciation for tax. This will definitely cause a difference between what we will charge as depreciation in accounts and what will be allowed as a deduction for tax. Let's take some figures and understand what is the difference that depreciation is going to cause between the accounting profit and the taxable income. Let's take a case of depreciation. Let's assume we buy an item of PPE. Let us say its cost is 10 lakhs of rupees. In tax, it is belonging to a 25% block of assets. So I'll be following the block of asset principle and providing depreciation at 25%. However, as far as accounts is considered, I have decided to follow the straight line method of depreciation. And let us say its useful life is 5 years. So, the point that we are trying to understand is that how it is going to be different in accounts and how it will be different in tax. So, useful life is 5 years. So, let's see for 5 years. We want to know what will be the tax depreciation and what will be the accounting depreciation. Yes, the accounting depreciation is pretty simple over here. 10 lakhs, I will divide by 5. Let's assume that there is no residual values. I am following SLM. So 10 lakhs divided by 5. So my accounting depreciation is going to be 2 lakhs of rupees every year. Isn't it? 10 lakhs divided by 5. However, when it comes to tax, I will provide depreciation as per the block of asset principle. We have considered it to be a 25% block. So take 10 lakhs in your calculator and multiply that by 25%. First year, 2,50,000, deduct it and multiply by 25%. Second year, 187,500, deducted and then 25%. 146.25 deducted and 25%. I am rounding it off. This is 1,05,469. And in the final year, I am assuming that whatever is the remaining WDV, we are claiming it as the terminal depreciation. So this is the depreciation that I will be providing in accounting books. But as you can see, this depreciation will be not allowed as a deduction. What will be allowed as a deduction is the depreciation computed as per the tax provision. And under Income Tax Act, following the block of asset principle, I have provided for the depreciation. So as you can observe, there is a difference between the depreciation provided as per tax and the depreciation provided as per the accounting policy. Now, as you can observe here, although there is a difference between the depreciation each year, but we must agree on one thing. The total amount of depreciation charged in accounts and the total amount of depreciation charged for income tax is the same. Please understand this. Every year depreciation is different. But if I take a total, this total is very clear, it is 10 lakhs. But if you will take a total of all these amounts, this will also turn out to be 10 lakhs. So the principle that we have to understand is that although yearly depreciations are different, the total depreciation that I charge in accounts and the total depreciation that I will claim for tax will turn out to be the same. Accounting Standard 22 calls this as a timing difference. Right, it says that this is a timing difference. Again, I'll take you to the most basic, the basic introduction that we were going through. The basic introduction is that what we are doing in accounting records and what we are doing for taxation, there is a difference. How should these differences be treated? That is the subject matter of Accounting Standard 22. AS 22 considers this difference to be a timing difference. Why timing difference? Because yearly, if you will compare, year by year is the time, right? Year by year, there is a difference in the amount of depreciation. There is not a single year where the depreciation matches. But if you look at the total depreciation, over a period of 5 years, I will charge 10 lakhs in accounts and I will claim 10 lakhs in tax. And that is the reason we say this is simply a timing difference. You know what's a timing difference? It is a difference that originates in 1 year or 1 period, you may say. It is a difference that originates in 1 period and reverses itself in subsequent period or periods. That is what we understand as a timing difference. I'll show you that. What I now do is I calculate a difference over here. Let us do an yearly difference. First year is simple, so I'll say it is 50,000. Right, from the tax depreciation I'm deducting the accounts depreciation. The second year it is 12,500. So second year I say it is 12,500. Third year, yes, 140,625 minus 2 lakhs. I get 59,375. 1,05,469. I deduct 2 lakhs. I get 94,531. And in this final year, I'm getting 1,16,406. And now take a total of this timing differences, right? I am calling this as a timing difference. Although I have written only difference, but it's actually a timing difference. You take a total of this. If you take a total of this, it will become 0. That is what we call as a timing difference. It originates in 1 period, right? The timing difference originates. Originates means it starts. It originates in 1 period and then reverses itself either in the next period or subsequent periods. So as you can see, it starts in the first year, then it is reversing itself gradually, and by the time 5 years comes to an end, it has completely reversed itself. Any difference between your accounting profit and taxable income caused by an item which is having a timing difference, it will ultimately lead to deferred taxes. More about deferred taxes later. More important right now is to understand the concept of timing difference. Okay, it's a difference which will originate in 1 period and will reverse itself in the next period or periods. For example, depreciation over here is taking 4 years to reverse itself. Not every item will take so much of time. There are certain items which may reverse itself probably in the next year itself. For example, in Income Tax Act, we have something known as Section 43B items. Right, I am referring to a specific section in the Income Tax Act, Section 43B. In this section, a list has been given. Those expenses will be allowed as a deduction only if it is paid in cash on or before you file your income tax return. For example, let us say employer's contribution to the provident fund. So let us say employer is also supposed to make a contribution to the employee's provident fund. Let us say a company has provided for this contribution on accrual basis. If you are following the accrual principle, this expense will get debited to the P&L. But I have still not contributed this amount in cash. If you have not contributed this amount in cash, then it will be disallowed for income tax. So understand the situation. Let us say the contribution to the employer's provident fund is 10 lakhs of rupees. So in the current year, I have debited 10 lakhs to my P&L. But that is following the accrual principle. I have still not deposited 10 lakhs in cash. So Income Tax Act says that because you have not deposited in cash, the deduction is disallowed. So you know what will happen in the current year? In the current year, 10 lakhs of deduction will be disallowed. This will cause a difference between my accounting profit and taxable income. Why? Because in accounting profit, I have already debited 10 lakhs. But when it comes to my taxable income, 10 lakhs is disallowed. So this will cause a difference between accounting profit and the taxable income. But you know what? In the next year, I deposit that 10 lakhs in cash. The very next year, I will get a deduction for the same. So what has happened? In the first year, there is a timing difference of 10 lakhs. Okay. In the first year, there's a timing difference of 10 lakhs. And in the next year, the moment I will pay it in cash, I will get the deduction of 10 lakhs. The difference which originated in the previous year, that difference is now reversing itself. So that is the concept of a timing difference. A difference that originates in one period and reverses itself either in the next period or subsequent periods. As against this, we are also having certain differences which will originate in one period but will never reverse themselves in next period, will not also reverse itself in subsequent periods. Those differences are popularly known as permanent differences. So just as you have timing differences, you will also have permanent differences. So timing difference, and now let's discuss what is a permanent difference. I have done something in my accounting books, but the taxation is altogether different. It is different not just in the current period, it will be different even for the subsequent periods. In short, what I have done in my accounting books will be simply not accepted for tax in the current as well as the subsequent periods. In such a situation, I will have a permanent difference. This is a difference that originates in one period but will never reverse itself. For example, let us say there is a company which is earning agricultural income. This agricultural income is credited to the profit and loss account. But we know that agricultural income is exempt from income tax. So in the current period, I will credit agricultural income to my P&L. My profit will increase, but this agricultural income will not be taxed will not be taxable for tax. And because it will not be taxable for tax in current period, it will also not be taxable for tax in subsequent periods. So this will cause a difference between my accounting profit and taxable income, but this difference will never reverse itself in future. That's the reason I say it is a permanent difference. For example, I have paid some penalty under the Income Tax Act. This penalty is debited by me to my profit and loss account. But when I will compute my taxable income, penalty paid under Income Tax Act is not allowed as a deduction. So you know what will happen? In my current year P&L, it will be debited to the P&L, but for taxation, it will be disallowed. It is disallowed in current year. It is also disallowed for subsequent years. So the penalty will cause a difference between accounting profit and the taxable income in current period, but this difference will not reverse itself in future. That's the reason I will call it as a permanent difference. So now trying to summarize the entire requirement of Accounting Standard 22. You know what we are supposed to do? As per Accounting Standard 22, the very first thing that you should do is you should compare your accounting profit and loss statement with statement of taxable income. You should make a comparison. What is your profit or maybe even loss as per your P&L, and what is your taxable income or taxable loss maybe as per the taxation provision. So you compare your accounting P&L with your statement of taxable income and identify the sources of differences. Right? We should just ask ourselves, why are the two different? Why is it that the profit as per my P&L and the income that is taxable as per my computation of tax, why are the two different? So I should identify the sources of differences. And these sources of differences should be classified into permanent differences and timing differences. You very well know what's a permanent difference, timing difference. This difference will originate in a current period and will never reverse itself in future. If you conclude it's a permanent difference, no further treatment is required. You have to now simply ignore it. So I will ignore permanent differences. On the other hand, you may have a timing difference. What's a timing difference? A difference that originates in the current period and will reverse itself in subsequent period or periods. Timing differences should be considered by us. As we will proceed ahead in this accounting standard, you will realize that timing differences result into deferred taxes. Right, that's the subsequent discussion that we have to do of this accounting standard. Just ignore permanent differences. Timing differences will give rise to deferred taxes. Either it will give rise to a deferred tax liability or it will give rise to deferred tax asset.
Press the bell icon on the YouTube app and never miss another update.